If I were starting a whole life insurance policy today, there'd be three things that I would want to fully understand because so many people have buyer's remorse when buying whole life insurance. So let's get into the three things that I think are most critical to understand. First, company selection. I have seen 4 companies consistently be able to prove that their whole life insurance policies deliver. Those 4 companies are referred to as the 4 major mutual life insurance companies. They're MassMutual, Guardian, New York Life, and Northwestern Mutual. Number 2, policy design. This is so important and it can be confusing to many. So with a life insurance policy, when you pay any dollar amount into your policy, you can actually choose where it goes. Where your money can go is A, toward what is called the base premium, or B, toward what is called your paid up additions rider. The short version of this is PUA rider. Now looking at those two terms, I like to call the base premium the initial insurance expense and the PUA rider a cash dump in. The reason why I like to call them that is because base premium dollars prioritize life insurance first and cash value second. It's very common to see the base premium give me 0 cash value in the first year, and sometimes the first and second year, depending on the type of whole life insurance product that I buy. Now, as you continue to pay premium dollars, eventually you will see the cash value build up. When I look at PUA dollars though, what I like to call that cash dump in, if I put money there, I immediately see it show up in cash value. It begins compounding. I can access it. PUA dollars prioritize my cash value first and my life insurance second. Now, I'll also need to add what is called a term insurance rider to my whole life insurance policy. The purpose of this is to prevent what is called a modified endowment contract from occurring, also known as a MEC. This is a taxable event. Why are people attracted to cash value life insurance? 3 core benefits: safety, liquidity, and it's tax-free as long as we follow IRS rules. That term rider is critical. We can typically reduce the minimum premium to about 10%. So what that means is if you want to be able to put up to $10,000 per year, you can set up a policy where your minimum is $1,000, 10%, and then the other $9,000 goes toward your PUA rider. And you know what else you can do? You can set it up so you are only billed for $1,000 per year, and then you can add the additional $9,000 at your discretion over the course of each year. And you don't even have to add more money toward PUAs. You can make it optional, which is very nice. So here we've got a policy of someone funding $100,000 per year and nothing after 5 years. Here's your base premium, about $6,700. Now we also have term insurance attached to this. We've got some term up here as well. So the all-in minimum premium in this particular example is right around $10,000, which is 10% of the $100,000 we see going into the policy every year. Everything else is going toward your PUA rider. So what this does is create a very cash-rich policy right out of the gates. So if we look at this illustration, you see $100,000 going into the policy in the first year. And if we look at the net cash value column, that shows your net cash value, what you have access to. It's just over 92% right out of the gates. Now, that modified endowment contract, we want to make sure that that does not occur, which does not in this example. We can see what is called the MEC limit down below, which is right here. So we've got a policy that complies with IRS rules and is set up for maximum cash value and also flexibility, because this individual can pay just $10K per year, but then has the ability to go up to $100K per year. Now, all insurance companies have different rules with respect to how flexible that PUA payment is, meaning when you can actually add money to the policy, but we've got other videos that cover that in detail. What's highlighted in yellow represents the break-even point, which is the first year your cash value is equal to or greater than the total dollar amount you've paid into the product. In this example, he could stop funding earlier, or he could keep funding it for a longer period of time. You can set the policy up really to be customized however you'd like in terms of how much you'd like to be able to fund and also how long you'd like to be able to fund a policy for. After the 5th year, he pays 0, and that cash value keeps on growing, which is sweet. The main takeaway with this is when I am getting a whole life insurance policy, I want to make sure it is designed with the minimum premium, as low as the insurance company will allow me to push it, and maximum PUA rider. That is the way to maximize your cash value. And when you look at corporations that purchase whole life insurance policies with the intent of maximizing cash value, this is what they do. They're beefing it up as much as they can. And if you want to follow the model that works, my encouragement would be to follow the money. Last point, number 3, policy loans. Here's a couple facts on policy loans. 1, you can take loans anytime you'd like. The earliest you can take a loan against your policy is typically 10 business days after you start it. The most that you can borrow is usually right around 95% of whatever you have in cash value. Loans work like a line of credit, meaning if you take multiple loans over time, you won't have them booked as multiple loans on your online account and each one has its own interest rate and such. No, it works like a line of credit. It's very, very simple. The interest rate can be fixed or variable. It depends on the insurance company and what options they have available. And then when it comes to loan payments, you can pay those back however and whenever you want. Most companies have online portals that allow you to request loans and also pay loans back. Whether you're just throwing money at the balance like you would with a line of credit or credit card, or you can set up auto pay if you'd like to attack it that way. Let's take a look at a loan model, shall we? So here's the exact same policy, and here's our policy loans. So firstly, what do we see? We see a $300,000 loan in policy year 6. Now I made it year 6 because that's after we're done funding the policy, and it just makes it easier to follow. Now, with respect to the payments, he's paying it back at $50,000 per year in this example, and we can see in purple how much is applied to the principal, and in orange how much is applied to the interest. Now the question I would have if I'm you is first, when I take that $300,000 loan, what do you notice about your cash value and death benefit? They drop by about $300,000. Now, as we look at that loan being paid back, you'll see the cash value and death benefit are being restored, but look at the values once that loan is paid back. What's the cash value? $870,000. What's the life insurance benefit? Almost $1.5 million. What do you notice about the example where you never touched it? They're exactly the same. So when you take a loan against your policy, the insurance company will charge you interest on that loan. However, they continue to apply interest on the amount that you've borrowed and the amount that you've not borrowed. They also hold your death benefit as collateral for the amount that you borrowed. That is what benefits them. Remember, they are a life insurance company. What's the first and foremost obligation that they have? To pay out life insurance claims. So what this means is if you die with a loan outstanding, they are on the hook for that much less. To put it simply, they are okay with that. There's one more thing to look at though. Here's what I would ask for if you're looking at a whole life insurance policy and you're analyzing loans. Ask, what does my policy look like if I never pay the loan back? Let's take a look. So we've got the exact same policy, exact same loan coming out, but what do you notice about the interest here? Keeps compounding. The reason why is because we're assuming it is not paid in this example. So when we look at the cash value and death benefits, what do you notice? It's never restored to what it was in the example to the left. However, as we scroll down, it still increases. The reason why is because the compounding on the policy is outpacing the loan interest. Now, if you overload it too early and the loan interest exceeds the growth rate on the policy, that's where you could run into a situation where it might lapse. That's why it's beneficial to ask what things look like if you don't pay the loan back at all. Or what if life happens and I can't pay it back? That's the kind of stuff that's valuable to see. Okay, let's recap. The three things I would want to understand before starting a whole life insurance policy are: 1, company selection. I always want to look at the 4 major mutual companies. 2, policy design. Make sure that the policy is designed with the absolute minimum premium and I am maximizing that PUA rider. And then number 3, policy loans. Ask to see illustrations before you start a policy showing what things look like if you borrow and repay, but then also if you borrow and do not repay. This will allow you to see a worst case scenario and avoid buyer's remorse. And as always, I hope this helps.